Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, make your own financial opinions, and make your own financial decisions. Today is Saturday, February 11th, 2023, and this is Blockhead Traders Weekly. This is actually kind of a little bit of a disappointing episode. We recorded this originally on February 8th, which was my birthday. It was intended to be our 100th episode. We had great content lined up. We made some tweaks to the way that we record, the way that we stream to the Discord. We had tested it all out the Sunday before recording. Everything worked great and it looked wonderful. And then we hit a snafu, it seemed. We did the entire episode, thought I was checking everything and getting all the streams and everything lined up correctly. I was really paranoid that we were going to lose video or audio. So I had redundancy recording of both the guests that appeared on the show, and all of that worked perfectly, except one piece. My local microphone was not recorded. So the entire show was done without any of my audio recording to disk. So it was available in the stream. We did the whole show actually live in the Discord. Everything was there. All the video worked great. But sadly, my audio was missing when I went to go edit after I pulled it all up. And it was kind of a lengthy episode. There was some really good content that was talked about. So I am going to try to dub in some responses that I had to some of the questions in this episode. It might not flow quite right because all of my audio in this episode is now coming after the fact. So I am listening to the original recording and then basically interjecting my comments to it, which probably won't match 100% with what they were before or things like that. So there could be some wonkiness in some of the responses or things like that. In general, I was very, very happy with the format. I'm a little sad it's going to be released this way, but we're going to try it out and we're going to revisit this topic in the future and try to do another episode like this. Only hopefully we will get all of the recording bits right and not drop any of the audio. So without further ado, let's go ahead and bring in the special guests of this episode. As it was the 100th episode, Viper and I have a younger sibling who is a little bit of, let's say, he's not really into the markets, has a little learning, a little skepticism, things like that. And so we thought it would be pretty fun to bring him onto the show as he doesn't necessarily trade himself at all. He has some inquiries about it, and we wanted to give an opportunity of kind of a live dialogue with him and some of his questions in a panel format. And so we brought him onto the show and essentially let him kind of ask whatever questions he wanted to raise, and then Viper and I kind of tackled those questions, and we didn't pre-script it, of course. Now you're getting my responses after we already recorded, so we'll see how all that fits in. But generally, my answers will track the same as they were. There's just extra commentary and stuff that I won't remember that I said. So we hope you really like this. It's definitely a different format than we've recorded in the past. Should be really good on audio. So if you're listening on audio, you won't really see any of the strangeness that the video had. But again, the audio transitions and things like that might seem a little weird. So without further ado, let's go ahead and bring in the guest, who is also known as Silverback.
Hello. Thanks for having me, Sprocket and Viper, and happy birthday, 29 years young. I am a blockhead. I am part of the Discord, but we'll probably find out by the end of this video if I'm a blockhead trader or a blockhead traitor.
Hey.
Though. So, interesting to be on here. Never been in this position before, but I am curious because I do watch the podcasts and the videos that get uploaded. I am curious as to the difference between trading and investing. I've watched the first video and you guys have gone into this, but I'm a little bit more curious about what is the mentality behind trading, and how are your goals different when you're trading versus when you're investing?
Yeah, I can go ahead and probably take that one here first, Viper, and then we'll let you kind of run the cleanup crew on that one. So for me, the big difference is time frame. To me, trading is a much shorter time frame, and depending on the type of trader, that time frame really can vary. In the Discord, we have a few members that are what I would consider more day traders, or maybe just a few day swing traders. I'm personally a little bit more of a time horizon in the 2 to 4 week range of the type of trades that I'm looking at making. And that is the biggest classification for me on trader versus investor. I'm basically trying to make sense of short term direction, short term price action, short term events to kind of turn a profit at a very small period. When I look at investing, I'm really looking at a longer time horizon. So for me, investing is multiple years, maybe even decades. So that's more, planning for retirement, looking at that longer time horizon. When I'm talking about trading, I'm potentially adjusting positions, maybe weekly, maybe every so many days. The whole trade is done within a matter of weeks for me. Some people, it's shorter than that. When I'm investing, I'm looking more at the longer term strategic direction of what it is. And I'm probably making adjustments no more frequently than maybe quarterly. So 4 times a year, 2 times a year. And it's more of a set it and forget it, or kind of long term strategic direction, where trading is a little more short term and tactical for me.
So I certainly agree with all of that. I'll for the benefit of Silverback's context, as well as anybody that has the similar question, I'll expand it a little bit and say that it's also just comes down to your personality and what you find interesting. So I agree, time horizon and all that kind of stuff, but it also, to me, there's also a fundamental difference between the two where they're both very technical things, but they're very technical in very different ways. So trading is everything very technical on the technical metrics and measurements of a particular price action on or price of a stock or an asset, we'll say. And there's all kinds of things that go into the most probable, like we talk on the show, the most probable move that it's going to make, and when you're doing options trading and the Greeks and all of those different technical measurements, price action, technical analysis, all that kind of stuff. So put all that into a basket of technicals and for trading, and then on the investment side, there are still very technical things. There's whether it's dividend yields, whether it's expense ratios, or all these other different things that make a company have this value and trajectory. That there's a lot of people that love those kind of technicals, that love getting a little more married to an asset of, I want to dig in and see what the financial guidance and what the financial decisions are being made on this particular company or underlying. And that's a completely different basket of technical focus. And then both of those yield themselves, like Sprocket was saying, to two different time horizons. But I would say you can still be an investor on a shorter time horizon, because if you get into those quarterly plays, what's happening in the fundamentals of the company for the next year, or striking an industry trend, or things like that. But so that's why I kind of break it into the two different technical things, which are very separate from each other.
Yeah, I think the difference that you're talking about there is you'll hear them referred to in the industry as technicals are kind of the mechanics of it, and then the longer term horizon are referred to as the fundamentals. The price to earnings ratio, the revenue, those type of things are more tied to the fundamentals, which in my mind matter more on the longer term horizon. whereas technicals are your price action, your kind of immediate movement. Really, they don't care what the underlying is. The technicals are basically devoid of the actual company itself. The fundamentals are the things that are relating to the balance sheet, company strategic direction, things like that.
So, Sprocket, you said during your answer something about plays. Do you call a play? What? How would you define a play?
Yeah, so I intentionally use the word plays, although in this past answer, because we re-recorded this, we didn't get the word plays, I think, in that. But I do use the term plays all the time on the channel because it reinforces in my mind that methodology that Viper and I always talk about, that you need to have a plan when you're getting into the thing. When are you getting out? Why are you getting out? What's your exit plan? What's your input? What's your thesis? What's your exit plan? And a play is much like that in sports, where you have the strategic plan. And it's not just I'm in it, let's see what happens. That doesn't necessitate a plan. And so I use play because it's a one and done. We're going to run this thing. It's going to go this way, this way, this way. These are the possible outcomes, and I'm going to execute on it. It takes the emotions out of the training or out of the trading and really lets you kind of facilitate movement in the market with less emotion, which is always a very good thing to do.
So in your long-term investment planning, you wouldn't refer to that as a play of a long time horizon.
No, that's right. To me, I mean, I guess you could. I don't do it that way. It's more of a strategic direction that I'm looking at long term.
That's the game, and then it's made up of plays.
Yeah. Actually, speaking of game, I highly recommend a video by Simon Sinek called The Infinite Game. And it's not specifically about trading per se. It's just about when you approach certain things in life and what type of attitude and approach do you go. And he talks about understanding when things are an infinite game, meaning there is no end to the game. And trading is one of those things where your goal is resource preservation. And the only way to stop the game or to get kicked out of the game is to run out of resources. And when you approach trading or investing or something like that as a finite game, you're already approaching with the wrong attitude because there is no end. There's no finish line. There's no I won, you lost. It's just about how you perform relative to yourself and how do you do with that capital preservation and wealth creation.
Yeah, so you talk about staying in the market. You ought to just use the quotes of the market. What is this market that we speak of? What are the components of a market?
Yeah, so for me, it's really about a place to go and exchange securities, financial instruments, things like that. And so there's many different markets that are out there. There is the New York Stock Exchange, the NASDAQ. All of these are very similar to, strip malls or larger malls or superstores or things like that, where you can go in and there's a plethora of products that are available there. And some markets have certain products and other markets have other ones. In real life, you have, the organic markets where there's healthy, whole food stuff. Then you have markets which are foreign markets that have, this is where you can go buy jackfruit or, typically imported goods and services and things like that in real life. And so the financial markets are very similar to that. You have the NASDAQ, which is a marketplace which exchanges largely tech type funds. You have the New York Stock Exchange, which has lots of large cap companies, things like that. You have a futures market, which is where you can trade things like hogs, corn, oil, commodities, things of that nature. And really, there's all different types of markets out there that allow different financial instruments to be bought, sold, traded. And that's really, to me, what the markets actually are. Viper will probably speak a little bit to crypto markets because that's a different type of exchange where you have cryptocurrencies, NFTs, things like that. A lot of people do consider that market. I consider that a market as well, but it's not necessarily one of the things that I regularly participate in when I'm trading.
Yeah, I'll tickle a little bit of any skepticism or cynicism and say that to me, a market, whether it's, I mean, certainly if it's crypto, but even in equities, that it's just kind of a form of regulated, legalized gambling. Like it's, you have an amount of capital or your own asset, and you're trying to place a bet that thing A is going to do X, Y, Z, and that you will be able to gain some financial wealth from that movement. I think that's a super boiled down version of it. But at the end of the day, I feel like that's also kind of what it is. And then like what those assets, what those things are, obviously varies dramatically and wildly. Just like in any form of gambling, whether it's super risky, or there's also some maybe not as risky things. But I feel like it's a similar parallel.
Don't worry, I'll get to that.
Man, you threw out the term gambling. Oh man.
So we got these different markets, and you make plays in these different markets. Are the markets that you play in futures, equity? Are they classified by the vehicles that exist in them, so that you can only trade futures with futures? Or can you trade equities with futures? Like, can I get out of a Civic and buy a semi vehicle? Or do you have to leave the market and go into another market?
Yeah, that's a good question. Probably the best way to really kind of address that is to go back to that store analogy that I kind of started a little bit earlier. Different stores carry different products, and sometimes they carry the same products, sometimes they carry variations of a particular product. And example of this might be the S&P. So the S&P is a Standard & Poor's 500 index. It tracks 500 companies and the price of those companies. There's a few different ways to trade that statistic or that thing. You have the SPY, which is traded in the equity markets, which is an ETF or exchange traded fund, which largely tracks the value of the S&P kind of by 1/10. So its size is about 1/10 of the actual S&P index. You have other products on equities markets. One of them is SPX, which is literally tracking and trading the raw index itself. You have futures, which can have S&P components to it. So there is a /ES, which is the futures of the S&P, kind of predicting where they're going to be in upcoming months, weeks. You can trade those. It's really about going into like a store, and you have Cheerios, Jozos, different generic representations of the same product, right? They're all essentially Cheerios, if you would, but they could be made by different companies. They could be bundled together differently, and you might have to go to a particular store to buy the particular brand or variety that you like to participate in. And that's really where the markets are. You can't kind of go between them.
Okay.
I would.
So, sorry, I don't want to. You talked about ETFs, which I do is a term I recognize. I don't exactly know what it is, but I've always wondered what is the difference between sort of holding an ETF and holding a stock. So a stock is some sort of IOU from a company, right? And an ETF, you're saying these different things track 500 companies. How do you own a piece of 500 companies? How do you own a piece of 500 companies?
So in general, I mean, I'm certainly not an ETF mutual fund expert, but in general, it's a concept of pooling money together, and purchasing a large basket of goods. So in the case of an ETF, let's just say 500 companies, 500 stocks, the best performing, like the index, like the S&P 500. The ETF, and Sprocket jump in afterwards if I'm completely wrong or off the mark a little bit, but it's a pooling of a large investment of these assets, and then that basket of asset almost becomes its own company, in that somebody can buy shares of that basket, and that basket moves relative to all of the things that make up what's inside of it. And when you invest in that ETF, whatever that ETF is priced at, it's priced based on the number of shares that the ETF offered to have a piece of what's in that basket.
Yeah, that's a very accurate way to put it. I'd add probably a little bit more to that about a thing called a prospectus. So there's all different kinds of ETFs. They don't necessarily have to track a particular index, but it's just a basket of stocks that, or a basket of, doesn't even have to be stocks. It could include bonds or other financial instruments, but it's a basket of investments or financial instruments that operate along a certain rules of engagement. And that's what the prospectus is. So every ETF that's out there, electronically traded fund, has a prospectus. And in that prospectus, it will state exactly what the fund does, what its objectives are, and how it operates. So, the ETF that we're talking about for the SPY, it'll say we'll maintain a representative share price or proportion of shares of this basket of S&P companies. Therefore, we're automatically adjusting things in the background to stay consistent with that. And that's where you get kind of actively managed and passively managed ETFs, where some of them are all computer programs. Those are passive. Active means there's really a person managing it. You can have ETFs that are around green energy or clean energy, so they're only doing investments in those type of companies. They might have covered call ETFs, which says, hey, our methodology of trading is we engage in covered calls all the time. And it's really about reading that prospectus to understand what are the objectives and mechanics that particular basket of funds, what are the rules of the road that it is living and abiding by. And that really guides you on what type of activity that is representative by that single ticker.
So the prospectus is telling you what's included, and the atoms of that, say in the equities, are the stocks of the set. And so something controls that, or stewards the ETF, right?
Yeah, no, and that's kind of what I was mentioning there with the active and passive management of the ETF. So you'll find actively managed ETFs, they'll tend to have maybe slightly higher fees, but that's really where there is a team of people that are basically deciding what to do, how to strategically operate. Those in the prospectus, they'll clearly state that this is actively managed, and that the fund managers that they hire to manage and be the stewards of those financial instruments, what decisions do they make, how do they make them, and then the other one's passive is more of we operate on this formula, this methodology. It's all automatic. We don't have people, making that buy, hold, sell decision. It's passively occurring.
Okay. Because another aspect that I was looking at was there's a couple terms, a lot being 100 shares of something, right? But 100 shares of, say, Apple or something is out of, I can't buy that. So I could buy a percentage of, or I could offer what I can to an ETF to then buy a bunch if they collect enough money, right? And then they're just kind of, when they sell out, you get a percentage of that.
Yeah, you really wouldn't see an ETF focused on a single company. It's more for diversification. So say you wanted to get into biotech, you could have an ETF that sprinkles money across multiple biotech companies. So you're exposed to a sector versus you trying to pick and choose what chunks of that sector you're going to be involved in, because you have limited funds, so you really can't do partial shares across all the entire sector. And an ETF allows you a single entry point, then distribute your funds proportionally, fractionally among a particular sector. That's typically where you would kind of leverage an ETF for diversification.
Like if
Economy of
there's
scale.
like if there's a sector, something that you want to be exposed to, but you don't, you just want exposure to the sector, not necessarily specific company ABC. You want energy exposure, then you could go find an energy ETF, and invest in it that way, to be exposed to that market segment without having to get into a specific company. So, for example, one of the, I mean, I guess I'll call it a play, but we'll see. It might turn into a long-term thing. But one of the ways that I have been getting back into the market after I pulled a bunch of money out and put it in cash for 2022 is through a couple ETFs, VTI, VOO, which are one at VTI is just a total market index, and VOO is specifically an S&P 500 index ETF. So a little bit of like why you would use that. The reason I'm using those is specifically looking at the market, looking at how 2022 degassed and, was just this big recessive crash down, and wanting to take cash and get it back into the market. Now, I guess I'll pause real quick and say this wasn't planned. It would just coincidentally, I happened to pull a lot of my investments out as the market crashed. You should never try to time the market like that. You'll end up losing a lot of money then, timing the market and all that kind of thing. But trying to bring cash into a market as it's on its way down. And at the time we were down 29, almost 30%. And so me looking at that going, all probabilities are the market will recover that 29, 30%. Timeline is always unpredictable. Could be a year, could be 3 years, 5 years, whatever. But the quote unquote play or the thesis of it was that we will recover that price. I don't know which companies are going to make it and which ones aren't. So I'm just going to start nibbling at these ETFs that represent the entire market, or also the S&P 500. And so that was my use of that vehicle of those ETFs, is to just start chipping money into that, because that, has that higher probability of going up. Then as we start to make a turn and get out of the bear market and into a bull market, although if you're in the Discord, there's obviously a lot of chatter of it doesn't matter if you're trading. You should be able to make trades both directions and make money both directions. But nonetheless, I have an investment bias. I have an emotional attachment to things that I trade or get invested in. So as we make that turn into a bull market, and we recover that 30%, and I start to see particular companies that I might want to invest in, then I'll try to start determining if I want to keep doing this ETF investment or start pulling that out, because in the general market, I think those are estimated to make 7-8% per year, something like that. So that's how I'm using those as general exposure, given current market conditions.
Okay, I got a few questions. I got to remember them though. You talked about you have an emotional connection, right? Because you're human. We're supposed to.
I'm a robot.
Your connection to investing if I'm purchasing shares in a company, am I purchasing it because I think that they're going to make money and do better, or am I purchasing shares to help that company? Do my purchase of shares help? I imagine only during like a public offering or something does it actually raise funds for them, and then the rest of the time we're just passing it around to different people who hold shares.
Yeah, so sort of. If you want to think directly putting money in the company's coffers, you're right. The only time that money goes directly to the company are times in which the company, you're basically buying the shares directly from the company, which is at the initial public offering, but it is also throughout the company's cycle. Like the company doesn't release all its shares, they keep a reserve. And so at certain times, the share price will go up to a certain value, and the board of directors will choose to sell shares on the open market to raise funds. AMC did this when they were getting, rocketed their price up to try to raise money, is the board voted to release shares into the market, which dilutes other current shareholders, but they can gather funds from that. There's indirect implications of a company's price rising, and it's how they access the secondary capital markets. So companies can sell bonds to raise funds, and bonds are essentially a loan. They say, hey, look, here is a piece of this debt. We will pay you this interest on the debt if you offer us some payment, and then we'll pay you back. And that share price is how company's value is. Think of it like the value of your house. So the higher that value goes, the more the company is worth, the easier it is for them to access secondary financial markets to sell bonds or raise funds or things like that. So it's not directly helping them from the actual share, but there are benefits for that company's price to go up.
So the only reason I ask is there are these things like socially responsible index, or tracking something that people would care about, and I'm wondering, does that really help your cause, or are you just putting the blinders on and being like, yeah, I bought this because I feel good about it, but you're just pushing stuff around.
I think it helps, but probably still a little bit to your point, it might not help as directly, as if it was a charity or something and you sent them money or something like that. Like there's definitely a marketability to it, because if it's a managed fund, I mean, somebody's making a cut on managing that fund, and so they're going to want people to invest in it. But I think it still has some merit in the fact that I forget the name of the platform. I mean, it might be Betterment or any of those robo investors that they make a name for themselves by bundling kind of exactly what you just said, of like, this is the green energy ETF, or this is the and find a bunch of different things. And I think there's still merit to it, because they seek out companies that are pursuing green technology, or whatever the bundle of asset is labeled as. They're seeking out companies that do that. And then, like Sprocket was saying, that by investing in that, you're raising the value of those particular companies, which then helps them, if they go from a $100 million valuation to a $800 million valuation, then they'll be able to go to the bank and say, we currently have $50 million of debt. We would like to take a $300 million loan to go achieve X, Y, Z, or whatever. So it does, I think there is merit to it helping, but there's always going to be an amount of marketability, I think.
I guess I only know the term bond from federal bonds. Are there bonds for anybody can issue a bond?
Yeah. So a bond is really just a coupon that says, I will give you $100, and in some period of time, you will give me back that $100 plus some percentage of interest. So at the bond expiration, you retrieve your interest payment, and you get your original capital back. And it depends on what the company is. The company wants to issue, what terms they have, but they can issue those in basically bond sales, and you can go ahead and purchase those bonds. And the interesting thing about bonds is they are in the line of creditors ahead of investors. So if a company is going to go bankrupt, those bondholders will get paid before any shareholder gets paid, because those are debts that are owed to the public, the company owes, and debtors always receive preferential treatment in bankruptcy proceedings and things like that over shareholders.
Okay. So if I'm investing, I'm investing to go to hopefully grow $1 into $2 or whatever with time. As it's in the investment vehicle, is this where trading comes in? If it's actively maintained, are people trading with that investment? or does it sit stagnant? More so like the ETFs, where it's an actively managed collection of things.
Yeah. So in the case of the ETF, effectively what you're doing is saying, hey, here's $100. Go invest this $100 the way the prospectus has it laid out. And hopefully you're building up value in that ETF. And then that basket of funds should grow by any returns that those investments make. So when you sell it, you're basically pulling that back out.
And so what you're doing here is using the tools available to you to dabble in what might happen with my more passive investment. You're just doing it directly as a blockhead trader.
Yeah, that's a good way to look at it.
Okay, which brings me to trading, which is good. I'd like to know, is this a hobby to you? How did you get into it? I mean, I know you were, you've had a Scott Trade account before TD Ameritrade, and then that's going to change names too. But I don't know when you got into quote unquote trading, Viper. I'm not quite sure what your story here is with the trading.
So I'll go first. The first question, if it's a hobby or what, I would say currently it falls a little bit more in line with hobby from an experimental level, a learning expedition, if you will. That doesn't mean I don't take it seriously or feel like I'm not playing with real money. I'm definitely playing with very real money. But the hobby piece of it is just feeling out kind of exactly what you just said of, can I do this more efficiently by myself, or am I just going to be better off if I would have just been throwing this stuff into ETFs or things like that? So, as things stand for me currently, I very much utilize tons of that ETF and managed fund things. Like my company 401k is, just set the ticker to whatever my risk level is, and I just let that thing get managed. And so what I'm trading with is a much smaller portion of my asset, of my total net worth. And the way I see it is a little bit like GPS in your car. Even if you're using GPS to get around your hometown or maybe an adjacent town that you're pretty sure you know the area, there's people who, even if it's their hometown, will just punch in their destination and they will just drive whatever the GPS tells them. And then there's other people who will punch in a destination and be like, now, why would you tell me to do that? I'm pretty sure if I make this, and I, cut these back roads that don't make sense to the algorithm and its objectives, but make more sense to you, even if it's something more natural of like, I want to stop at this store on the way or something, blah, blah, blah. To me, that's a little bit of my objective is I am a very hands-on DIY person. And so I'm trying to gauge, the ETFs and everything are great, but you're always going to pay some amount of total efficiency for reliability, if you will. And so I'm kind of exploring what are my own abilities to do this myself.
Oh yeah, Sprocket. How about you?
Yeah, for me, it's all about I started in 2019, and, it was about trying to figure out, and I dabbled in markets before that to some degree, but it was really about planning for retirement and knowing that, hey, at some point, I need to be able to be self-sustaining because I'm not going to have an income from my job. And I want to be able to make sure that my financial assets are secure. My financial future is secure so I can do the things that I want to do in retirement, spend time with family, travel, things like that, and not worry about, hey, where is the income coming from each month? I want to figure out how do I set this up so that in retirement, I have a steady stream of income. And I started experimenting with trading to see if that is a way that I could create a stream of income. secondary to my day job or things like that. Because if I can do that now, there's no reason I couldn't do that in retirement. It's not necessarily something that is, oh, you have to be a certain age, you have to have some skill set or something like that, right? There's no reason that somebody can't sit at home and do this type of stuff in their retirement or sit on a beach or wherever they are. And so for me, it was really about that self-education to experiment now, so I felt more confident of it to achieve that in the future when the time comes. And so really for me, it's about a learning experience presently.
And to add one thing to that is the black magic. Having a very, technical background and technical mindset, there's so many things that we run into in life, especially in the technology field, since that's obviously something we're all very accustomed to. So many things are looked at as this black box of wizardry. And I guess having that background of realizing, no, not really. Like, no, it's just this machine that does ABC, and this is why it does it, and it gives you da-da-da-da. So that kind of led me to this of like, no, let's crack the box open, because I don't think that guy that's, charging whatever is really doing anything that complicated. And that's not to say everything needs to be a DIY approach. I'm not going to go into my, daughter's brain surgery and say, I got this. I've been reading some books. But there are things that I think are worth cracking the box open and taking a look and saying, you know what? I think I can understand this. And then key to all of that is what we constantly say as far as risk mitigation, risk tolerance, and all of these things. When you start to dabble in that, it's not, I think I can do this whole hog. It's, take the bites and start toying and playing. And I think that's where I'm at, is the toying and playing part of that. Do I ever foresee it going, some full-time big thing? I don't know. That's not really my goal. My goal right now is just to learn something new and take a little more financial control off of somebody else and onto my own back.
Would you say that the Blockhead Traders thesis is that you can outperform the market to see if you can or not?
Yeah, I mean, I think that's the goal. I'm certainly not going to do that with my total market index investments, but yeah, I think that's probably a good place to start. Is if you see the average market returns, you learn a little bit about how those are generated and how people make money, and then you look at that number and you go, I think I could do better. I think that's kind of where a little bit of the sparks and the kindling are. Yeah,
actually, that's excellent thing that you brought up there. Silverback is all about that. Okay, how do I compare against a passive market index fund? I regularly track all of my investments, my trading performance, and I'm constantly measuring it against that S&P index. Because if I am doing worse than the S&P index, I'm wasting my time. I might as well have just put it in a passive fund and done better. And so I want to make sure that I am able to at least achieve same or better than that index year over year over a time period.
And to do some hollerbacks, what is not part of my plan, goals, thesis is to make the world a better place through my investing. It's like you were mentioning earlier, as far as like trying to invest in a company to do better, or so, like I save all that like time and place, the proper vehicle for everything. And so for me, those sort of things, I want to be more hands-on with where I do those things, whether it's charitable or whatever. There's better vehicles for doing those sort of things. I don't have any goals for any of those ideological things with the market.
So when you're trading, do you view you versus the market, or do you view you versus an adversary trader?
Yeah, think
I mean, like, what do you when you click in the buttons and you got your graph and your arrows that point up, and you're like, I think it's going to do this. I guess what's going through your head then?
I view that as me versus statistical probabilities, me versus red candle, green candle. I mean, to your point, there's very much an other side. There's always somebody on the other side of the trade. But I don't view them as, any part of my decision making, or even, whether you want to call it decision making or empathy or sympathy or anything like that. I view the statistical probabilities of those technical indicators, like we talked about with price action, technical analysis, and I view it as me versus the statistical probabilities of it doing what it's signaling it's going to do.
Yeah, I view it as me versus me too. It's neither of those choices you gave.
You're the buyer and the seller?
No, but the type of things that I trade are typically options, which is a whole nother ball that we could get into. But a lot of the vehicles that I'm trading and the strategies that I'm taking, there's not necessarily a winner and a loser. It's not black and white, right or wrong, win or lose. A lot of the approaches in the options world specifically are you can have two winners, and both people made different directions on the trade, but they both came out as winners. And so I don't focus on the other side of the trade. I don't focus on any of that. It's just, how am I doing relative to myself? Am I sticking to my plan? Am I trading emotionless? Am I achieving my targets? It's me versus me. There is no one else that I'm really comparing up or measuring against or anything like that.
So after having done, I don't know how you can, okay, this is part of my question. How long have you guys been trading that you would call yourself a trader? And who do you think should be trading?
So I would say I've actively been trading a year and a half. And there's been a lot of talk on different episodes about pros and cons of that. Starting trading in the raging bull market of 2020 into start of 2021. So that's 2.5 years. So I've been doing it about that long, 2.5 years. And I would say who should be doing it is probably a little more on that ideological level of anybody who is dissatisfied with how their investments are being done, or whether they're being done at all. I mean, if you have a certain amount of reserve in saved cash in your savings account, and you're starting to creep up over that, where you're like, well, I needed X amount in savings, and now we're creeping up over that. If you're fine with that, then maybe you don't need to be investing. But if that's starting to make you feel uncomfortable, of like, I have what I need, and now more is going in there, and I know that the bank is just taking this money and throwing it into the market, and trying to make money off of it. Like, I want to have more control over that money. Or if you have your savings and you're, like I said about the market return, if you are dabbling a little bit, but you're just doing ETFs and things like that, and you're just dissatisfied with how that's going, and you feel like maybe you could do better. I think that's, to me at least, that's kind of the type of people I would think should be doing it. But I guess it's complicated, because even on a simpler level, on that ETF front, like a total market index or something like that, I think that should be thought of as more accessible to people. And I think that's kind of something we try to show on the show, is just the accessibility of it. And again, demystifying that voodoo black magic box of like, no, it's not really that magic. It's just a couple this, that, and the other.
For me, I would say I've been actively trading now since 2019. I dabbled in things, before that, but I really didn't start buckling down and learning until 2019. And to be fair, the first 3 to 5 months I spent researching and reading and basically consuming all of this educational material prior to my first trade. And, who do I think should be trading? And I would say anybody that has a desire or sees a problem. A lot of times, there's no, the people that are going to be most invested in their success, no matter what it is in life, is somebody that recognizes that there's an issue and wants to make a change in that area. So I don't really think there's a rule that says you should be trading or you should be trading. I think everybody should understand the mechanics of wealth building and understand how that works, how those things integrate. And if they're completely satisfied with the way that their current wealth building strategy is working, they don't have a desire to want to learn, they don't want to do that, then no, I don't think it's for them. But if somebody is not happy with their wealth building, with their structure, then I would strongly advocate that they go out and get research on the topic. And I don't think it's so much of you have to trade. It's really you have to understand the mechanics of that wealth building machine. How does it work? How does it tick? Where do you fit in? Because there's this black magic out there that I think people just get stuck in their brain at a young age that say, oh, I can never succeed. That's not for me. That's only for the professionals. But the part that I want to expose to people is there really is no such thing as a professional, right? There's really no such thing as that type of, yes, there's somebody that spent time, energy, and education in it, but the stuff that they've learned is not unattainable by the average person. So I really do believe that if the average person has motivation, they can get that education. They can seek that out. They can better their knowledge. And then they too are now empowered to change their wealth building strategy to make a positive impact on themselves, their family, their legacy, and stuff like that. And so that's who I think really should get into the mechanics of wealth building.
Okay, Viper. Since you briefly dabbled into, you mentioned the gambling term. Being in Ohio, I don't know, if you have any other Ohio viewers, but we are constantly bombarded with sportsbook. Macon Sportsbook. It's now here. We can gamble on sports. What do you think the difference between the short-term trading is, whether that be day or the 1 to 2 months, and knowing sports so well that you enter into sort of the sportsbook gambling realm?
Phew. I asked for it by using the G word. No, so if I rephrase the question a little bit, it's kind of, where's the line between gambling and what I just referred to as gambling?
Yeah, like we think of gambling. I think of it sort of as if your goal here is to have autonomy, then gambling to me is really just a dice roll. Maybe that's not how gambling is, but to me it is, because I don't understand the inputs to it. That's why I was asking so much about like what goes into a market, what is the definition of a market, how are they traded, what are the pieces, what are the vehicles. Until I understand that stuff, I don't see how I could possibly participate with autonomy without understanding what the sort of platform or the playing field I'm on is. So if we translate that to gambling, to me, it feels very similar. Whether you're guessing if this chart's going to go up or down within the course of an hour, as to if the Cavaliers are going to beat another sports team.
Go sports.
Go sports.
I definitely can completely understand how it how it looks that way, and to some degree, that's kind of why I a little tongue in cheek used the word earlier, because that I kind of want to highlight the importance of that education and that knowledge, because there are people that absolutely there is no difference. The Wall Street bets of the world, the people that come running in, we like the stock, and so we throw a bunch of money at it and it does a thing and we all did it and hooray, whatever. You can absolutely get completely gambling level wrecked by not understanding the machine that you're walking into. But I think kind of one of the vocabulary you use there is important to bring up again, and that's the inputs. In the gambling, this will be the last time I say the word twice. In the gambling case, sportsbook and craps table, and think the input is random. The input is in the case of sports, there's some statistics behind it. I mean, a lot of stats, but they're all, it all comes down to an element of complete randomness of each individual player's performance on, and yada, 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 how sports work. And certainly, obviously, in the casino, craps and all that kind of stuff, like the input is random, and then it will generate a random output, and you're just hoping that you are on the right spot. That's not to say that, trading or investing is a sure bet, because there is still an element of randomness to it, but I feel like the inputs to it are a little more well studied and a little more technically founded and easier to predict, again, to the degree of probability, which is something we try to always talk about, is nothing is a sure bet, and so thus that's the corollary to gambling. However, there are proven setups to a play or something like that where the inputs given have a higher probability of yielding a specific output, and that's just the nature of those inputs not being a dice roll on the table sense of randomness. And so that's kind of where that education comes into play, is to learn those inputs and how they can somewhat dominate the machine's output, even though there are some inputs that will always be random.
So, in your opinion, does sportsbook map closer to trading, since you have the skill of a team? It's much less pure probability.
I mean, maybe, but also I've seen the spreads of a sports book. I mean, it's will player A score 3 touchdowns, or will the final score be, plus or minus this? Like, I mean, that's still no statistic in the world is, let's just stick to the probability thing. The probabilities of any of those outcomes really never gets over 50-50. And I think maybe that's a little bit more to what my point is about the more deterministic inputs in an array of inputs, where a certain set of them are random, the other set that are a little more predictable. There are conditions where you can have that higher than 50% probability, which I just don't think, when the element is so humanly derived in sports, I don't believe you can really get to deterministic probabilities in your favor.
What do you think, DraftKings?
Yeah, I think understanding the term gambling is the definition of the word means different things to different people. Effectively, gambling is, to me, by the strictest definition of the word, if you don't know the outcome and the outcome can change, you are basically gambling. That you're basically gambling every time you get in your car to drive somewhere. You don't really know that you will arrive at your destination as expected. Anything could happen. You could get a flat tire. You could get distracted. You could get an emergency phone call. You could get in a car wreck. And so, the probability of that might be lower. And so, you have a higher confidence level that you're going to arrive at your destination. But the end outcome is out of your control to some extent. And so for me, gambling in the terms that most people think of, like Vegas and slot machines and all this like random chance, is really the less you get than the 50-50. So the more that the probability is against you, the more closer to the traditional gambling, or what most people in my mind think of when we say gambling. The trading is really about education. It's about knowing how the machine works, and it's never about a sure thing. If it was a sure thing, everybody would do it and everybody would make tons of money. It's really about recognizing how the machine works, where things turn left, right, up, down, and the probability of that outcome, so you can push your outcome probabilistically in your favor. And you can only do that from education. And so I think if you go into the markets completely uneducated, completely unknowing anything about it, yeah, you're 100% gambling, because you're just bet on red, bet on black, bet on zero. It's the roulette wheel. Now, once you understand the ins and the outs of how the markets facilitate, how trades flow, why things do what they do, I think then you can then put thought, mechanics, strategy behind it, and have things that are more probabilistically in your favor. So it's kind of like at the casino, right? There's there's only one game, right? Statistically, the odds are in your favor. It's blackjack. I think it's like 51% to 49% in house's favor. And really, it's just pot odds that you're always dealing against. And so for me, it's about how do you take the knowledge of the markets and form them and mold them into a strategy where you have shifting that probability more in your favor. And the farther away from 50-50 you go towards, the guaranteed method, that's the closer you get to away from gambling definition.
At risk of killing a potentially dangerous analogy that the gambling has let us down, to some extent, it's almost like as far as differentiating gambling and trading and investing, trading and investing, you're allowed to count the cards. That's something, card counting in a casino is something that gives you a statistical advantage. And to some degree in trading and investing, obviously nothing along the lines of insider trading or anything like that, but learning the machine and learning how and why it does what it does, that's part of the game. That's how you play.
So, would you say, Sprocket, in the chat, I don't know which channel it was, but in the chat, somebody was trading VS, and you mentioned that it's sub $2. And that is a dangerous realm.
Yeah, if you go ask that guy that posted that, I'm sure he'll say, yeah, that's straight up gambling, and that really is it's dangerous, because if you don't understand why that underlying moves the way that it does, in very sporadic notion, with low liquidity, low volume, you're basically at the mercy of these large whales that can come in and completely buy up that entire allocation of shares and really manipulate the price. And staying away from that, or understanding why that is, right? That's part of the awareness. If you get to a raging river and you just see, all these rocks and water and stuff like that, and you just think, oh, but I know if I get in a boat, I just kind of flow down the river and it's beautiful. You might not recognize the danger that is there among rapids and rocks and things like that if you're in a canoe. And so I think it's about recognizing why might that be dangerous. That kind of comes into play there, particularly with that VS, right? If you know the dangers that you see there, then you can contextualize them, understand them, and take them into account in your risk strategy. But if you're just blindly going in there because it's a $2 stock and it might go up, you're in world for hurt.
So, are there some guardrails as to how to keep yourself out of just betting? Like you're saying, liquidity is one. Are there a couple other just like basic things to look out for?
So he called this out on the last episode, and I looked in. I mean, we looked at it a little bit more closely after the episode was over, but really, price might. I mean, price is a decent indicator, but it might not be the complete picture. I would say one of the safest guardrails to look at would be price combined with the float, the shares outstanding of a stock. So in the case of that VS, price is currently $1.08, and currently there are roughly 13 million shares outstanding. So you just do the math real quick. $13 million is all it takes to buy up every last share of stock that's in the market, and then just make it do whatever you want. Pump it up or reverse it, shorting it, those 13 million shares, and send it down, which then, the GameStop examples and things like that, the short squeezes then causes all sorts of trigger effects and things like that. But I think the float shares outstanding is combined with the price is a pretty solid starting point.
Yeah. So as far as guardrails go, in the trading of that, I would say it largely depends on the style of trading or the types of trading that you're doing or investing. And so I think it really goes back to that education piece, and you find what style it just is appealing to you, and then deeply learn about that style. So there are so many avenues and aspects that you can go down, buying shares, selling shares, options, just a whole host of things that you could go as your trading strategy that you tackle. And it's really about finding what gets you excited, what interests you, and then really know every nook and cranny about that particular type of trading. So for me, I had kind of started with options. I'd read a lot about options. People had said, "Oh, these are so dangerous, never touch them." And that was kind of intriguing to me to say, well, what's so dangerous about it? What makes them tick? And then I just started looking about that financial instrument. What is an option? How does it work? And just pouring over information on that, and then finding out, well, there's buying options, there's selling options, there's call options, there's put options. And the more and more that I looked into it, the more and more types of traders that I kind of came across, the styles of their trading, just selling options was appealing to me. And so that's what I poured a lot of my time and energy into, really focusing on that. And from there, it organically grew into exposure to other types of trades, where I would then look into the mechanics of that type of trade and how does that work. And so each style has its guardrails that are in place, let's call it. And, I can't sit here and highlight all the guardrails that you need to look out for, because they might differ based on your approach in the market. So doing one thing, you might need to pay attention to this set of guardrails, where this other strategy that you might deploy might be a completely different set of guardrails, or maybe some of the things that were guardrails over there don't apply to this one. And so I don't think there is a rules of the road per se that's easy to kind of sum up in one checklist, pop, 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 of what that is. And I think that's where you have to go through and do your own exposure. Just pick one aspect of it and drill in, learn it, know it, and develop the guardrails around that. And I will see how that goes from there, and where you grow and learn from that. And that's one of the reasons that Viper and I, in our 1% trades and things like that, are trying to touch on different styles, because they're not all the same type of trades. Viper typically is longing or shorting or doing price action movements. I'm typically doing options. Sometimes I do covered, uncovered. And it's really that exposure to all these different things. And one of these are going to click probably for you. One of them will be like, ooh, I want to learn more about that. And then go down that road, figure that stuff out, learn that machine, learn that mechanics. And it's really all about education and understanding and knowledge. Because once you have knowledge, copying somebody, that's not knowledge. Understanding the why, the how, that's real knowledge. And that's where you're going to see a differentiation in your trading performance, in your trading enjoyment, is that next level of understanding. So that really brings us to the end of what we have time here today for this episode. It actually was super fun to record this, despite the fact that I was missing my microphone as far as the editing goes. I think there's really good content that we kind of covered in here, just touching on a lot of subjects. I strongly encourage you to, follow us on YouTube, watch our videos, get in our Discord, interact with us on the Discord. It's free. It's open to everybody. You can talk to us. Reach out, follow our blog posts, stuff like that. It's all about education. And by all means, don't just use us as a source of information. Use us as a jumping off point or an exposure to something, and you go to another area to learn more about it. Let us know actually specifically how you like this format of this show. It's very, very different. It was actually a lot of fun to create this way, and we'll look into doing other formats like this in a panel type format where we can have kind of a dialogue with guest or guests, and really kind of have that discussion that probably goes on in people's brains, but they don't know who to ask. They don't know where to get that answer or hear that answer. And so if we can kind of pull some of that out and maybe talk about it, maybe we'll be able to bring some of those questions into the light that you might have, and just kind of raise them on this show. So a lot going on in the markets aside from, our general discussion for newbies. The Fed interest rates are out there. We have CPI coming up. Just a lot of movement there, a lot of volatility. So, whatever it is, I hope you find interest, dig into things, go seek that education, find a friend. If you can't find one, hop in our Discord, talk to us. We're a very welcoming community. But that's really where you're going to better yourself as a trader, as an investor, as that wealth building exercise. So good luck out there, as always. And remember, think outside the block.